When I talk to a business owner and they say, hey, look at my income statement or look at my P&L, look how profitable we are, but where's all my cash? I say, okay, are your financials accurate? And a lot of times they may or may not be. A lot of construction companies, the jobs can be high dollar jobs. Revenue sounds appealing and it's exciting, but if you're not bidding the job the right way, you don't understand that if you're profitable, you can run yourself out of business pretty quickly.
Less stress, more time, more money. Welcome to the Cash Flow Contractor interview.
Martin, I want to hear what the text is that you got this morning before we got started.
Well, it's coincidental, but we're going to be talking about 3 or 4 subjects today. And one of my newest clients texted me 5 minutes before we got on. And I told him I'm having a discussion on a podcast about this very subject. Got to go. Talk to you later. But without naming him or even telling what state or business he's in, he's just an absolutely perfect example that I'd like to go to in a minute here.
Well, we will jump to that. We have our guest Jason on. Jason, welcome to the podcast.
Yeah, thanks guys. Glad to be on.
Yeah. We'll let you introduce yourself a little bit towards the end, but for listeners, Jason is a wonderful business person in the financial arena. He has over 70 employees that are accountant-based employees and help with fractional CFO roles, controller roles, and getting things straightened out. Today, we're going to be talking about why your financials aren't accurate. We're going to go deep into the details of why this happens in construction companies specifically. This is going to be a big lesson for me because I am very immature in this area of business for construction companies. But I've learned a lot through Martin. I'm excited to learn more through Jason today. So I'll ask the silly questions, but I'll let you guys go in at a deep level. Let's just start really fast, Jason. Like, why do financials matter so much to a construction company?
Yeah, I mean, well, the obvious point is you have to make sure you're making a profit, right? Construction, a lot of construction companies, the jobs can be high dollar jobs. Revenue sounds appealing and it's exciting, but if you're not bidding the job the right way, if you don't understand that if you're profitable, you can run yourself out of business pretty quickly, right? So that's the highest level. And then obviously breaking down, and probably the discussion that Martin was having with his colleague earlier is how do I have a little bit more visibility? How can I use that information to be able to make decisions as I look forward versus, running by, just the inherent knowledge I've gathered over the last number of years in the industry. And I think a big challenge with owners in this space is that, they grew up in the space, they know how to do the work, they knew how to do to produce a quality, to run a quality project, to produce quality work, but their experience isn't in finance and accounting. And as a business owner, you need to start to learn really all aspects of your business and build that infrastructure to support the growth and the vision that you have for your company.
Sounds like I'm hearing Martin.
Sounds like we're brethren.
Yeah, for sure.
Almost
for sure.
Yeah, I always say if you don't have good books with which to make decisions, it's kind of like driving forward, looking in the rearview mirror of your car.
Yeah,
and that's even presuming that you have a rearview mirror. A lot of times,
sometimes the rearview mirror is cash on hand, and then you run out of cash, right? And then all of a sudden it's like, okay, how do I make payroll?
Yeah.
Right?
And a mental list of who owes you what and approximately how much I owe, and oh yeah, I forgot this, and oh yeah, that guy didn't pay, and pretty soon you're in a disaster.
Right. Well, and I think you don't know what you don't know, and I think there's a lot of listeners that think they do have accurate financials, but they don't know what they don't know, and so maybe this will help. The goal of this podcast really is to help contractors understand the most common pitfalls that they're gonna face in keeping their financials accurate, and so maybe you will resonate with a few of these things today, and it'll start to change the way that you look at your books. At the end of the day, there's a reason why people like Jason are out there, is because you can't do it all. And so we always talk about having trusted advisors on your team that you outsource things to, that you trust, that you learn from, and that you lean on to be able to be the best business person you can. So let's jump into the first one. WIP reports, work in progress. What is it? Why does it matter?
Let-
Or Martin, do you want to go a different direction?
Yeah, let's go back before
Okay.
that just a little bit. Of the most common problem that I see is just like Jason said, you need accurate financials. Did I make money or did I not make money? Now that's the first question. Then there are a lot of cash questions and others going along with it. What are my margins? If my margins are insufficient, what can I do about it? That's where you get a lot of management expertise. You say, I want my margins to go up 1%. And I mean, from like 40% to 41%. How can I do it? All of a sudden, you now have clarity. Oh, the guys don't leave the shop on time, or oh, we're wasting material, or oh, we make trips to the supply house, all of these things. So it points you, having good books gives you that kind of information. And the thing that we're talking about today, I think one of the great, the topic of today is most businesses, and Jason, I'll let you speak to your experience, but I'm going to say 90% of the 10 million and less contractors I deal with, $10 million sales and less, do not have books sufficient to make good business decisions. Okay. Lots of reasons for that, and we'll go into them. But even if they keep the books, there are some really common things that throw them off and make them inaccurate. And that's one thing I want to talk to you about today. I think I already mentioned it, right? That I was texting with a new client that has been with me about 2 months. He's in another state, won't even mention his industry, but he sent me his financials when we first met. And his net profit was 50% of sales. It was 49.5% of sales, which is really, really good, right? That means you sell $1 million, you take home $500,000 before tax, right? So I'm going, He said, well, my bank account's all reconciled and all this kind of stuff. I said, well, let's get on and get on board and all this, and we'll take a look at it. Well, I quickly found that what happened was he had invoiced an entire very large job completely in December. Let's call it 400,000. That's not exactly right. And had done about 200,000 other work, but he had $400,000 showing up in sales. He hadn't done the work.
That'll skew your margin.
So that's one thing that happens. And we'll just, I'll list these and we'll go through them again. But that's one thing, matching the invoice with the cost, right? Another way of matching comes in is people get deposits, even if it wasn't an invoice. They get a deposit and they put it in the bank and call it sales. Well, it's not sales. Right. That's not your money, right? Because you haven't incurred any expenses against it. That's the other side of it. People go out and buy some stuff. You buy a bunch of mechanical equipment, electrician, buy out the whole rig and the lighting package, and they put it in cost of goods sold, which is an expense. They don't have any revenue. So 1 month they've got billing that came in, not billing, but they've got deposits that came in way overshadowed costs. Next month they got a bunch of costs and no revenue. So what I hear all the time is roller coaster profits. Guy looks, he goes, oh man, we made $400,000 last month. And then the next month we're 200,000 down for the year. What's going on? So those being two things, cash deposits, work in process, inventory, and I'm trying to think,
Mapping,
cost of goods sold, WIP. So trying to get good books is the issue. And how can we do that? Because it's well beyond most individual business owners figure out.
The other challenge too is what you mentioned is your colleague who is showing 50% bottom line. Now they're when they file their taxes, they're paying taxes on that. And so now they're actually paying more taxes than what they should be paying because they're showing more profit than they really have. And so a lot of times, owners, they don't realize, okay, well, hopefully, I'm paying the right amount of taxes, at one point. And so now you're just giving the government more money than you should be.
Yeah. If they're paying on the accrual basis. The other side of this guy though, is we haven't looked so far this year, but this being January, he's going to have big losses because he booked the income last year and now he's got all the expense coming in January and February this year. So, guys like that, I don't blame them. They say, I don't look at my books because they don't make any sense. It's crazy. And because they don't make any sense, because they're not done properly, they can't do all the things that you can do if you understand your
Yep.
margins and what your break even is and what it takes to pay. So anyway, if you want to
Yeah.
choose one of those subjects, maybe cash deposits, and talk about how they should be handled, then we can talk about WIP.
Sure.
Let's start with the WIP.
Yeah,
So
okay.
what is work in progress? Why is it significant to construction accounting specifically?
I want to add one thing to what you said, Martin, is that when you have, and I'll get into WIP real quick, is when you have the roller coaster of numbers, it's already challenging enough to get a banking relationship as a general contractor or in construction. But it's impossible. It's nearly impossible if you're showing numbers like that, right? If you give the bank numbers that that they can trust and with consistency, there's options out there for financing. But if you're not using your numbers, if you don't have confidence in them, the bank won't. You won't be able to do that. So that's another direction there as well. But from a WIP report, we talk about the work in progress. I mean, I look at the WIP report as in the construction industry as the Bible or the source of truth, right? Of really what's happening with your business. If you don't have anything else, you can run your business fairly effectively with and understand your jobs and your job costing with a WIP report. And the WIP report is really what helps you to define and develop accrual-based financials, like you were talking about, Martin. It really gives you a visibility into, from its basic level, it's a one page. It's got a number of columns going across. You have an understanding of what the original contract value is, and then your costs associated with completing the contract. So that upfront, you should have a good visibility into what your estimated profits will be upfront. That then, and what your margin should be. So now upfront, you have an understanding, okay, before I even start, here's what my bid is, here's what my cost should be. And now I can manage against that, and I can track my costs against my budget that I hopefully have on a job by job basis. Number one, and then I can also track my billings that I billed to the client. In some cases, I've billed in excess. You have a couple columns: billed in excess of costs and costs in excess of billings. So you're able to track all of that. And then from a profitability perspective, most construction companies are on a percentage completion method. And what that means is I recognize revenue, not when I receive the cash, like in Martin's example, but if I have $1 million contract and I'm 20% complete with that contract, I'll recognize 20% of the revenue. So I'll recognize $200,000 at that point in time. It doesn't matter how much I've invoiced, doesn't matter how much I've collected or not collected. That is my revenue. And that's how I record that. And my costs then should align with that revenue. So that on a month, let's say, make the example easy, $200,000, I've incurred, $150,000 in cost. I know that month I was $50,000 profitable in that month. Obviously, things can get a little bit more complex with change orders and those types of things, but it should allow you to manage the cost on your engagement or on your project, so that you can control and see into the future. If you see, okay, hey, this is getting a little bit out of hand, there's some changes going on here, this may impact the profitability of my engagement. What decisions do I need to make to be able to improve or impact this for the better? But this is, that is the simplest form of, hey, a good contractor is constantly looking at that on at a minimum, probably a weekly basis, saying, okay, where are my jobs moving? How successful are they? Am I maintaining my margins that I expected going into this? And it's a critical tool for all contractors.
Yeah, and I think the contrast, I know listeners that I'm thinking of, where would that money be? And the distortion would be, hey, I got paid 20% and or I got paid
Yep.
50%. I took draws and
Yeah.
they covered them, and I put it
Yep.
all in income. And then again, on what I spent for labor and materials, I put that all
Yeah.
in an expense, but they're not correlated
Right.
with each other. So you don't really know. Yeah, WIP is a critical component that keeps you matched up for a period. What percentage of people that you encounter in contractors keep track of WIP? And
Yeah. It's for the smaller contractors, it's challenging because the accounting tools out there, several of the softwares out there, they're not able to effectively, that are being used, don't effectively generate a good WIP report that spits it out, nice and pretty for you. So a lot of contractors, they develop their own through Excel if they can. A lot of contractors that you mentioned in 10 million and under, they don't have that. They're just kind of using the gut check on how jobs are going, right? And you can get away with that if you only have a couple of jobs going, but once you have a handful of jobs and significant volume of jobs, that just can't be done. And to your point, Martin, if you're doing this effectively, it evens out your financial performance over the year, and it creates that consistency so you can truly evaluate the performance of your business instead of that roller coaster of ups and downs based on when you collect the cash, when you make payments, et cetera. And so then you get a true picture. You can understand the trends of your business, where you're at. You mentioned margin before. I love margin and talking about margin and how important that is. 1% margin on a $10 million business, a difference, that is $100,000, right? So 1% margin, if you improve your overall company performance by 1%, that $100,000 drops straight to the bottom line. For a contractor, for a business owner, that goes right in your pocket, right? Or that gives you the ability to reinvest back into the business, hire an additional individual, superintendent, whatever you may want to do. But margin and understanding your margin and having, what is your goal? How do I maximize that is so critical. A lot of times I'll see individuals will say, "Hey, what are your margins?" Well, it's around 40 to 45% or 38 to 35. Well, is it 30 or is it 35? Because that could be a big difference, right?
yeah,
So I like to
that's
get down to
yeah.
even the percentage point, and sometimes you're even breaking it down even beyond
And
that.
is it? Oh man, we're blood brothers, man. No, the other side of that is, well, first of all, I like to go into the bidding process with every new
Mhm.
client I have. And a lot of times they don't bid by paying
Yeah.
attention to margins. They bid some formula they've got, and I use $250 per cubic yard and so much. I go, no, what are
Yeah.
your costs? And divided by one minus your margin, that's your bid,
Yeah.
unless you can beat it, you can go up. Uh, but one of the stats that I throw out all the time, I say the average company, and this is pretty close to average, a contractor has a 35% margin, makes 7% to the bottom line. That's real common. If you can improve your margins 1%, you'll increase your net profit
Yep.
15%.
Exactly. Yep.
That's the math, what you just talked about. If you can increase your sales 20% and hold your overhead the same, you'll double
Yeah.
your net profit. And when guys hear numbers like that, they say, "Well, wait a minute, I can
Yeah.
do that." 1%. It's only 1%. No, it's 15% of
Yeah.
what you made,
Yeah. And it's
right?
also
So anyway,
but the key though is to be able to understand and be able to ensure you have accuracy in how you're in the numbers in the first place, right?
what your real
So if
margins
you're
are.
looking at your numbers
Yeah.
and say, well,
Yeah.
it's 35%, well, you got to have confidence it is, because now if you're you're making decisions to impact that, you have to be able to track and understand how you're doing that. And that's the
Right.
critical point. It's so
Right.
true that profitability is more. I talk to business owners all the time, and they're all revenue, 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 and that's great. And a lot of it depends on what your ultimate goals are, how your business might be valued, those types of things. But the key is to run a profitable business if you can as well. And if you can squeak out an additional percentage point in margin, or even more than that, that allows you to reinvest back in the business if you want to, allows you to take home more cash as a business owner if you want to. It makes a big, big difference.
Yeah, and if you're looking at selling your company and maybe a 4 or 5 multiple, it's you save $100,000, increase your net. You just added 500,000 to your
Yep.
net worth, in valuation. Not that simple, but
Yeah.
that's still the
Yeah.
way to think about it.
So I want to back up a little bit, Martin. So I've never looked at a WIP report myself, right? What, it doesn't sound too complicated, but it also sounds kind of mysterious. So kind of give me an example, and we'll put one in the show notes. We'll grab one from online and put it in there for people to look at if they haven't seen one. What's a good WIP report look like? What are the numbers you're going to be tracking and seeing? Is it custom? Is it fairly straightforward and standard? Kind of give me the rundown of that.
Sure. A basic WIP report. A lot of firms will do it even in Excel if they have to. A good software system will produce that based on the inputs into the system. But a lot of contractors, especially on the smaller end, they don't have the resources to produce, to invest in that level of a system. But in its simplest form, you have on the left side rows, you have your jobs. So you have each job listed on the left side, stacked. And then across the top on the columns, you have, you start with what's our total contract value? What's the revenue we're expecting on this job as a whole? So if it's $1 million job, we're expecting $1 million in this revenue. And then the next line would be, what's our expected cost to incurred to complete this job? So let's say it's 800,000. We're expecting a 20% margin on this job. Let's say, and so then you minus the 2, and you can see your estimated profit. And then, so that's the starting point. From there, then as the job starts, you're tracking your cost to date. And that's why it's so important to be looking at this on a weekly basis versus a monthly basis, depending on how fast the jobs are going. In some cases, you need to be looking at this on a daily basis, depending on the type of job that you're incurring. And so you're tracking, and next to that, the total cost to date. So let's say the job's going to be a 10-month process. You're 2 months in, and you're tracking your costs at that point. Now, at that point, you can say, okay, based on the job costs, if we're continuing to be on budget, we can understand, based on the job costs, let's say it's a $800,000 cost, and we've incurred $200,000 in the total job cost of 800. We've incurred 200. We're about 25% done with the job, assuming that we're still on track, and we feel we're still on track. So now you can understand that based on the profits that we estimated that we were going to make, we can calculate what our profits were, and we can also calculate what our revenue should be at that point in time too. And that is what you see on the far right side of the WIP report: is your cost to date, the profit you've earned to date, your percentage completion, and then you're also tracking how much you've billed for the job, and if you've billed more than what you've incurred, or if you are behind and you've incurred costs in excess of what you billed as well. And that basically covers the entire WIP report. And that's why it's so powerful, because you can see what the job should be, what your profit margin should be, and you can see where you are at any point in time. And then you also can see where your billings are on the engagement.
Really, the idea of tracking costs sounds pretty daunting. So you're tracking your payroll, and you're allocating, if you got 5 jobs going, this crew, these guys were at this job, and you're managing that. Somebody is saying this labor went to this job.
That's right.
Correct?
Yeah. So that's the other challenging part, is less sophisticated, smaller firms or contractors or construction firms. It can be more challenging to track time and labor and where the team is to appropriately allocate those costs to specific jobs. So it's important to develop a process to be able to do that. And when you have people that are out in the field, probably less sophisticated than you are, that can be challenging sometimes to get, sometimes you feel like you're herding cats a little bit, but having a good process in place is critical to be able to get that information.
Yeah. A couple of things that I've seen it inside of Buildertrend. I personally have never helped anybody set it up in Buildertrend, popular project management software for construction companies. I know it integrates directly with QuickBooks. And so if you are a listener and you're using Buildertrend and you're doing works in progress through Buildertrend with your integration in QuickBooks, we'd love to hear from you and see more and learn more about
Yep.
that. I've also heard about, in kind of doing some research for this episode, Notify. I have no idea if it's quality. They talk a big game and have great testimonials on their website and videos of electricians and stuff talking about things, but they integrate directly with QuickBooks as well and give you kind of a dashboard view and WIP reports. And it, for listeners that don't understand how much these things cost, separate from your QuickBooks subscriptions that you pay, Notify, it looks like is around $200 a month roughly, which seems reasonable if you're going to be given really good WIP reports. And then Buildertrend, the pricing varies, but I know that you can get in for as little as $100. I'm not sure if that includes the WIP reports, but I think on the high end, you're looking at $300-400. I know Buildertrend also gives you a lot more information than just a WIP report. You can actually manage your entire projects, pay your subs, all that kind of stuff through Buildertrend. A little bit of a hard user interface to work with, but it works. So moving on from there, I think the WIP reports is great. Dashboard view of exactly what you are looking at on a job and what's real, not just what's in your head, not just what you think is happening or you're assuming is happening, but it's your scorecard on that project. So let's talk about customer cash deposits. This is a big one that you wanted to talk about, Martin. Why don't you give some context for us?
Well, it would fit if you're doing WIP and a whole lot of things correctly, it might cover this, but as a separate subject, it happens all the time. People get deposits. It might be 10%, might be 30%, might be $5,000, might be $50,000. And what they do with it is give it to their bookkeeper, who puts it in the bank and maybe writes an invoice and receives it against the invoice and becomes part of sales. And the problem with that is the fact that you received a deposit is not sales. I mean, it's going to turn into sales at the point that you've earned it. So it overstates. It's just further complication. This is all goes together in matching. But I see it all the time. And it's basically what happened with the guy I was talking about earlier, who made 49% to the bottom line. He just got deposits, right? Put them in sales. Woohoo! Had a great year. Well, he's not going to be happy next year unless he repeats it at a higher level. So where should deposits go?
So I mean, you're exactly right, Martin, that if you're producing a good WIP report, it should flesh this out from a job profitability perspective. But deposits are basically a liability because you haven't earned that cash yet. So it's not appropriate to be calling that revenue until you've really earned that by performing the job. And so the deposit will be earned when the job is done. It depends on how you bill. Maybe earned up front, maybe the deposit, maybe at the end, there's some deposit that you have to return at some point. But the deposit initially goes on the balance sheet. And I know the balance sheet can be a scary thing, but what I will say is that if the balance sheet is not accurate, your profit and loss or your income statement is not accurate. And those two things go hand in hand. So if you're just looking at your income statement and saying, "Hey, look at here's my numbers," and you say, "Well, I don't know how the balance sheet works. I don't understand that." There's big risk that again, your income statement may not be accurate. To Martin's point, as an example, if you put deposits in revenue, your revenue is overstated, and deposits really should be on the balance sheet as a liability to the company because you haven't earned that yet. And that's the biggest point is revenue should be what you've earned and done the work on and completed. And the cost of performing that work should both be recorded in the same period. So in the same month. And if you're doing that consistently, you have consistency across the months of the business and the years of the business. You can see trends. You can see what your margins are. You can start to make decisions to improve those margins. And then when you have discussions with a third party, not only somebody like Martin, but a third party like a potential new investor or partner, or a banking relationship.
A
Yeah, bonding
bonding
company.
company.
I was going to
Um,
say that.
What's
Bonding
first
company,
thing that
absolutely.
all of those individuals are going to ask for? Let me see your financials, right? And if you're hitting print on QuickBooks and you're sending that out, you're giving them, that's the story you're giving them. So it's better to control the story, make sure you have good information, make sure it's credible, make sure it's in a good format that tells the right story of the business and makes you look credible at the same time. And that in and of itself, and having that knowledge base and be able to speak to financials, it's amazing how much easier it is to get capital in that situation versus I'm trying to get financing of some level or the bonding company, and I have a bookkeeper. You go, here, talk to my bookkeeper. They'll help you. 9 times out of 10, you're not going to get the result you need or want.
Right.
And I want to go through a really quick scenario of the cash deposits. Like, let's just play it out, right? So let's say we are a home builder and we think that it's going to take us 7 months, or maybe let's do the easier number, 6 months to finish building this custom home. And we get a cash deposit for 50% upfront. What's the best way to handle that?
Yep. So you take that, you put the money in the bank, which is great. But you also have to understand that's not my money. So the first thing is there's a couple of things. One, you have to be able to manage your cash effectively. If you say, hey, I got extra cash, I'm going to bonus everybody out, or I'm going to take some and I'm going to buy a new car or something like that. Well, you're setting yourself up for trouble later because you have to use that cash to perform on the job, right? So cash management is the number one. That's number one critical component there. The second is you take that money, you put it in the bank, and you put it on the balance sheet as a customer deposit liability. So your income statement is still all zeros. There's no revenue, there's no expenses yet, assuming that you have nothing else going on in your business. So you take the money, you put it on the balance sheet, you put it in cash, and it's a liability. Now, the first month when I start working on the engagement, I may be able to apply some of that deposit and move that from the liability over to revenue based on the amount of work I've performed. Sorry, go ahead, Bert. Yeah,
The WIP report.
Right, yeah,
No,
based on the WIP report, right? So now I have developed a WIP report, and based on the WIP report, I know how much revenue or what my costs incurred were. I know the percentage complete that I am on the engagement, and I can calculate the revenue. And so at that point, I can move over some of those funds from the liability over to revenue. The costs then that were incurred are also in that month. And now you have a true picture of what happened that month as far as profitability on the engagement. And you can also it helps you to manage cash flow. Cash flow can be managed separately, obviously, but especially in businesses, what we see all the time is cash management is critical. But now you have a good representation and your financials are a true picture of what's really happening here.
Yeah.
No. Okay. That's super helpful. And then when is it, how does it change as I finish the job? Anything need to be changed as we finish out and close out the project?
So when you close out the project, obviously you need to make sure if you have any excess deposit, it gets returned or paid back. That does not impact your profitability on the job. That's just simply returning a deposit, right? So it's not an expense to the company. You've already recorded all the expenses associated with the job. If sometimes there may be some true ups, you're estimating the cost to complete percentage throughout the job. When you get to the end, you may be a little bit off. Hopefully you're as accurate as possible. But when the job is final, you true it up at that point. But because you're managing that on a monthly basis, the true up should be nominal. And because you're managing that effectively on the WIP report, any adjustments throughout the job and what changes are happening, you're managing that. And so you true up the job, you make sure that your invoicing is set up appropriately, that you've invoiced for any amounts that are left over, or if you've received any cash in advance or in excess of what the job costs or job revenue should be, you have to pay that back. But none of that really impacts or should impact the income statement, right? So that's all kind of on the side. That's all part of the balance sheet. The income and the profitability and the cost of the job are very consistent month over month based on what you see happening. And the flow of cash has no impact on the revenue and the expenses of the job.
Gotcha. Okay. And one last thing on this, and Martin, I know you wanted to say something, but um, effective strategies to like manage cash better in these situations when you get a cash deposit. I'm very unfamiliar here. So like things that come to my mind are just having an income account that is for deposits at your bank, where deposits just go in there first and they don't go into your actual just checking account where you see this big number and you think we can, well, we can use it. And then slowly moving it from that deposits account as needed over to my checking or expense account, whatever you have. But any other strategies, maybe that's a terrible idea. Anything that you've seen work for people?
I'll start, and then Martin, I want to hear your thoughts too. Yeah, I think you can certainly do that. I think that if you're closing your books every month, if you're managing your financials in an appropriate way, you shouldn't have to set up a separate account to be able to track that. So if you have good financials that you can trust and you have visibility, you have a good understanding of where your business is at that point in time. So that's the first item. The second is managing cash flow, and cash flow forecasting is done outside of your basic financial statements. So you have your balance sheet and your income statement, what we talked about, but we have to be able to look into the future and understand what are our cash flows of our business. There's some cash flow tools out there. Most companies, especially in the smaller industry, will do it in Excel. I'd be happy to provide you with just a standard template that you can pass on to your listeners. But the idea is to be able to see at a minimum 3 months in advance. We call it a 13-week cash flow. Beyond that, you're starting to guess a little bit, and you're not quite sure kind of how things are going to pan out. But if you're updating your cash flow forecast every week, and you're always looking forward 13 weeks or 1/4 of the year, basically, then you should have enough visibility to react to what changes may be happening in your business. And so those things need to be taken into consideration. You received a customer deposit. Okay, well, we have that. We know we're going to incur those costs in 3 weeks over here. So let's make sure we account for that in our cash flow forecast in that column 3 weeks in advance from now, so that we know, okay, we got this cash now. We know it's coming out in 3 weeks. We know what our balance should be at that point in time. Obviously, there's a lot of inflows and outflows, but based on invoicing, the timing of collections, you should have a good idea of what your industry is like in collections. In construction, it's unlike most other industries where in construction, nobody gets paid until the person before them gets paid, right? It's like, well, I'll pay you when I get paid, right? And that's seems to be the rule of thumb in construction, and no other business is really like that. But it certainly helps businesses manage their cash better when they owe, but it's difficult when you have to wait 90 days to receive your invoicing. But being able to manage that and understand that timing is critical. And if you can see that into the future, you should be able to have an understanding of the inflows and the outflows of your jobs and the expectations of what your work is going to be performed, to be able to really see and visualize what that is, and ultimately make good decisions.
Yeah, the only thing I would add to that is, 13-week look ahead cash flows. They're always really hard because you're projecting, I'm going to receive this, I'm going to receive this, my payroll is going to be that. And some things like the phone bill and the rent are easy, but it's always hard. But the exercise of doing it causes you to think differently, causes you to develop instincts that, not going to do that, I do have some cash, but there's a stress here. So it's an exercise worth undertaking. And another place that I like to see people is they understand their current assets as a percentage of sales, inventory, which you can't do if you put your deposits in sales, but current assets as meaning your receivables and your inventory as a percentage of your sales. There's some sophisticated things you can do, but there's some pretty simple things. Just look at it and say, my month's sales always wind up. So if you're going to increase your sales by 100%, you're going to have twice as much cash to finance your accounts receivables or your inventory. Might be able to improve it, but that's the way to plan. So
if your
no,
terms
go
on
ahead.
your accounts receivable are 90 days, that means that when you invoice, you're not going to receive that cash for 90 days. You're going to show revenue, but to Martin's point, as you grow your business, you have to be able to fund that growth. And so understanding the collection process and understanding how to fund that growth. A lot of companies, that's their biggest challenge when they grow is running out of cash, because it's all hung up in AR or inventory, as Martin mentioned, and it's not in cash. Even though you're experiencing a lot of success and growth, you're in a cash crunch. And that's where having good financials in it, and you are growing, you have opportunities, even through banking relationships, through outside parties. If you have good financials, you can show that trend of growth, much more likely to get that outside financing to help you finance that growth if you need it. That being said, if you manage your finances effectively, you can you can get pretty far without outside financing as well.
Yeah.
I want to say one thing real quickly. Statement of cash flows is an obscure report. Most people have never heard of it. Once you get that and take a little, I've got a whole section on it in my book, hopefully makes it easy to understand. Once you have that, it tells you exactly where every penny of your cash went. And once you know that, you can do something about it.
And I want to make sure that we're not
Anyway, it's
confusing.
important.
A statement of cash flow and a cash flow forecast are two different things. Statement of
Different
cash
things,
flow tells you where your cash went historically, and
Historically,
a cash forecast is looking into the future. But you can leverage that statement of cash flow to help you understand where your cash might be going in the future as well.
Right.
But so they're two very powerful tools that are the statement of cash flow, as you mentioned, Lauren, it can be very confusing to clearly understand. The cash flow forecast should be is very clear. Okay, I got money coming in this week. I got money going out this week. I got money coming in, got money going out. And so it really helps you, if anything, to really understand your business in that level.
So you had mentioned inventory whenever where your cash can be tied up. And Martin, I know that you've talked a lot about inventory being one of the biggest challenges with finding a really good bookkeeper for a construction company, is that it's challenging to track. It's challenging to have someone who can be inside your business and understand the inventory. I think our best example of managing inventory was Michael Barnett of Barnett Electrical, which I'm sure there's several places that you can do this, but they literally had RFID tracking on every single piece of inventory. So when it was taken off of a truck, that's when they were actually billed from the supply house. So they partnered with a supply house to set all that up. They even had a cage that was literally consignment, basically, from the supply house inside of the warehouse at their place of business, so that if they pulled anything out of that cage as well to take to a job site, it got marked to that truck, and that truck was marked to that job. And so the inventory was correctly marked and categorized to the job and when it was pulled off the truck. So basically they weren't having stolen inventory, but obviously that's really sophisticated. And that's probably the most accurate way I would think that you can get in real time, right? But that's not the reality for most people. Why is inventory so hard to track? Why does it cause so many distortions? Let's get the rundown.
Well, I'll start real quickly. But the problem with inventories is opposite of a cash deposit, right? Most people take their inventory and expense it. I mean, they go buy a semi-load worth of conduit that's going to last them 3 months, but they just expense it. So they've got this big expense. So it's the opposite of a cash deposit. But I'll let you talk about why it's so hard to track. Because somebody's got to bring it in and somebody's got to check it out, and it's just hard to do.
So there's that piece. And what I always say as well, when I talk to a business owner and they say, hey, look at my income statement, or look at my P&L, look how profitable we are, but I have where's all my cash, right? And then I do two things. One, I say, okay, are your financials accurate? Okay. And a lot of times they may or may not be, but let's assume they are accurate. and they say, look at how profitable I am. Where's all my cash? And then I look at their AR and I look at their inventory. And I say, okay, well, your AR is 90 to 120 days, meaning you're not collecting. So that's part of your cash. And the other is you have 5 months of inventory on your shelves. So you got your cash is on your shelves, right? Your cash is sitting there in your warehouse, but you can't spend that cash because it's being used. It's assigned to jobs, let's say. So so managing inventory and the flow through of inventory is critical from a cash management perspective, so that you're not basically, so you're not spending, so you have cash flexibility. And so being able to have some level of a tracking component, like your colleague or that you mentioned, Khalil,
Yeah.
that's amazing. When I hear that, I mean, I get excited about that, right? I mean, they're tracking
Yeah.
it. When they need it, they grab it. They have a process where their supplier actually puts them in consignment in their warehouse. I mean, that's fantastic, right? So they don't even have to take ownership until they take it out of the cage. And so something like QuickBooks is not going to allow you to really effectively track inventory. There are inventory management tools. There are, some of the tools I think that you mentioned may have that capability as well, Khalil. Sometimes
Sure.
when the other challenge is you get so many different softwares and tools and components that are all trying to tie into each other, then it gets impossible to keep them all together. And so you start
Right.
bolting on a bunch of stuff, and then a few months later, your team is back to using Excel, right? And no one's using the system. And so
Yep.
I would say managing inventory to the minimum levels to allow you to be effective, but still to be flexible is critical. That helps you to manage
Yeah.
your cash flows. The other, as Martin mentioned, from a financial statement presentation perspective, is the inventory should not be expensed. It should go back on the balance sheet, like we talked about deposits. It's an asset. You own it. It's an asset. It should not be expensed on your income statement until you actually use it on a job. Once you use it on a job, it then ultimately goes into the total cost of the engagement, and then back to your WIP schedule, right? Now we're 40% complete. Okay. Now we can cost X amount, 40% of the contract price we can now record as revenue. And so that's why the WIP schedule is so important. Why we keep going back to it, because everything then goes and relates to that WIP schedule. And if you are even doing a WIP schedule and you're buying inventory and it's for 5 months and you expense all of it, well, you have an inaccurate representation of percentage of completion, and so your financials are misstated as a result.
Yeah. Martin, where do you see people normally coming in here, and how do you resolve these inventory distortions?
Well, let me jump to Michael Barnett, who has the RFIDs. When I first met him, and he's on our podcast, so he doesn't mind I say this, he runs a multi-million-dollar electrical contracting business. And I first met him, I said, do you have inventory? And he said, no. I said, okay, let's see the shop. So we went out to his 8,000 square foot shop, and it was floor to ceiling inventory. I said, what's this? He said, well, that's stuff we bought. Well, 150,000 or something like that. So, no idea where they stood. Where do I see people? This is why we're talking to Jason. Okay. Number one, here's my principle. Good books accurately reflected that show you margins and other information, an accurate balance sheet, enable you, Mr. Business, Mrs. Business Owner, to make good decisions about managing your business. Without them, you do not have the information to make good decisions. So it's critical. Number two, from having listened to this, it's complicated. Okay. I love this stuff. I bet Jason does too. And to me, I'm going, oh, come on, man. It's easy. Just take it out of there. That's an expense. Put it over here on an asset and we'll expense it. And then I have to know the QuickBooks clicks to do that, or whatever software I'm using, not just the principle. I need to be able to do it. So it's really hard. And what happens is mostly it doesn't get done. And therefore, we go to the third leg of what I'm talking about. Critical, hard, get somebody who's capable to do it for you. Because you cannot, I'm going to say this blanket, you cannot thrive in business, especially something like contracting, thrive without good books. And so that's kind of the logical. You get somebody, Jason's not the only guy in the world who does this, but you get somebody who can keep it for you and present it to you in a way that you can use it to make
Yeah.
decisions.
I'm going to add on to that too. It's thrive and grow, right? I mean, business owners and entrepreneurs, they get into a business because they want to grow and they have a goal of growing. Maybe they want to exit or sell, or, they want it to be successful. And I see a lot of times companies, they can get to a certain point managing it without, understanding financial aspects of the business very well. But there always comes a point where you get stuck. And a big part of that is if you don't have clarity around cash flows, about managing the profitability of your projects, the overall business, it makes it near impossible to take that next step as a business. So you get to that point and you just keep running in that hamster wheel, and you get frustrated and you can't get out of it. And having good financials, going back to point number one you made, it will allow you to make good decisions. It gives you credibility. It gives you additional ability to bring in outside capital. It allows you to really become more profitable and make decisions to become more profitable. I mean, there is additional cost potentially. A lot of times you have to, and I talk to our clients all the time about this, is if you want to grow, you have to build the infrastructure in your business to support that growth. And so what you had as a $5 million company, you probably can't have as a $10 million or a $20 million or $30 million company. And that goes not only to accounting, but all aspects of your business. So if you started with a bookkeeper and you were 5 million, it's not reasonable to think that that same bookkeeper is going to be sufficient at 10 million or 20 million or 30 million. So there is some level of investment to sustain and to ensure the sophistication to grow. And Khalil, that's where you come in too. I mean, they have to start investing in sales and marketing to keep that up, to grow, right? I mean, that is an investment.
Yeah.
And so a lot of times we come in as an additional cost potentially to the client, but it's a cost they have to make regardless if it's us or somebody else, or they hire a full-time person. They have to make that investment to see the results of the things that we've been talking about. And that's the key point, is we can't come in, wave a magic wand, it'd all be cost neutral. Replace a low-level bookkeeper and get all this great and fun, fancy and exciting stuff for free. But we can work with you to, as we mentioned, 1% on $10 million is $100,000, right? Right to the bottom line. We, not us, but a good financial CFO or controller should be able to get you information to see that and help you make decisions to determine how to improve that 1% or that 2%. And we do that on our business all the time. And 2% on our business is huge. It's so big.
Mm-hmm.
And 2% on a lot of businesses is game changing. And so that's, I think, the way to look at it. There has got to be an investment. Got to bring in Khalil, sales and marketing, and you got to invest in, your accounting infrastructure to be able to have that visibility to take that next step.
Well said. I think this has been really valuable. I think one of the more tactical and in-depth financial episodes that we've done. So hopefully it brought clarity for people. I think that, if people are struggling with this, it's, Martin, you said that this is really challenging and it's often just avoided, but the obstacle is the way. And we've even talked about that many times before, right? Like if you're really going to make that push, this is one thing that you can't skimp on. So, Jason, how can people get in touch with you? We'll put stuff in the show notes, but
Sure.
What can they do to get in touch?
Yeah, our website is signatureanalytics.com. If you go to our list of some core industries, construction is one of them. So that is a core industry that we focus on quite a bit. among others, obviously, but that's really a core. So you can click on that and get some more information there. I'm always happy if you want to reach out to me directly. My email is letter J Kruger, Kruger at signatureanalytics.com. And our website is signatureanalytics.com. I think I forgot to mention. And honestly, I like to talk to business owners and people that and get to know you. And if anyone has any questions, and if I don't know it or we don't know it, I probably know someone who does and can point you in the right direction. So I'm happy to, if anyone wants to call me directly too, 858-228-5643. And I just like to get to know business owners and see if I can help them in any way.
Excellent.
Fantastic.
Well, thank you so much for being on, Jason. And maybe we'll stay in touch and have you on another time.
Sounds great. Thanks, guys.
Absolutely. Take care.
Thanks for listening to The Cashflow Contractor. Check out our website in the show notes or visit thecashflowcontractor.com.